Welcome to our R&D tax credits and the IRS How to Prepare for Audit webinar. We like to begin all of our webinars with a little bit about our company. KBKG was established in 1999. We have offices across the US, including Illinois, Pennsylvania, Arizona, Ohio, Georgia, New York, Texas, and Pasadena, California, where we are headquartered. We provide turnkey tax solutions to CPAs and businesses. Our engineers and tax experts have performed thousands of tax projects, resulting in hundreds of millions of dollars in benefits for our clients. Our team is a diverse mix of tax professionals, attorneys, engineers, and economists from various disciplines. This combination of talent allows us to be the best at what we do and maximize results for our clients. KBKG is a preferred provider for thousands of CPAs across the country. I will now introduce John Tucker, our R&D principal. John Tucker is a principal for KBKG's R&D consulting practice. Based in Atlanta, Georgia, John has over 16 years of experience providing federal business tax advisory services to clients in various industries, including technology, manufacturing, transportation, healthcare, retail and consumer products, hospitality, media and entertainment, financial, and other professional service industries. Prior to joining KBKG, John has spent nearly 15 years at Big Four firms, leading advisory and specialty tax groups. John provided support to clients with implementation of specialized tax consulting projects, including R&D tax credit studies, tangible property capitalization, Section 199 deductions, cost segregation studies, transaction cost analysis, as well as various tax accounting methods, including revenue and expense recognition. John primarily works in the R&D tax credit, capitalization, cost segregation areas. He is involved with consulting, technical review, training, project management, and representation before the IRS. John has received his Bachelor's of Business Administration in Accounting, as well as a Master's in Taxation from the University of Georgia. Now I'll turn it over to John to introduce our speakers.
So I'd like to introduce two of KBKG's Directors of R&D, who will be our main speakers today, and that's Jack Jolly and Mark Bodenstab. And so Jack is a recently retired federal employee of over 32 years, where he spent his first 12 years with the Department of Defense as a production engineer. However, his last 20 years is with the IRS and in the Large Business and International Division. He's served as a field engineer, engineering team manager, territory manager, and a senior analyst. He has been the lead instructor for several classes where he's teaching engineers on how to examine the R&D tax credit at the IRS. So Jack has spent a lot of his time reviewing and auditing R&D credits at the IRS. Mark is a Director of Research and Development Tax Credits and is also 20+ years of private industry and 14 years with the IRS, where he also served as a field engineer, engineering team manager, and staff assistant. He also has reviewed and audited many R&D tax credits at the IRS. So now I'll turn over to Mark to begin the presentation.
Thanks, John. This is Mark. Good afternoon, everyone. Today, our agenda will discuss and address the IRS's audit process with respect to the research credit. Who conducts the audit? What specialists might be involved? What is the real definition of qualified research? The areas of focus during examination, what resolution means, and perhaps appeals. And we're going to close out at the end of the discussion with your rights as a taxpayer. All right. Okay, who really is conducting the IRS audits? And you should be aware already that the IRS is composed of 4 major divisions that conduct audits of tax returns. The first is a wage and investment group. There's a tax exempt and government entities group. Small business and self-employed is SBSE, and the large business and international group, LBNI. These 4 divisions are looking at all the returns, and the research and development credit is almost exclusively examined by the SBSC and the LBI divisions. Let's just compare the differences between SBSC and LBNI. They have different procedures and directives. Some sections of the Internal Revenue Manual are applicable to both, but both do have specific sections that do not apply to the other division. The big difference between SBSC and LBNI is really in the taxpayer assets. That's a definition. If a company has less than $10 million in assets, it's going to be part of the SBSC environment. In SBSC, they have a single revenue agent that is assigned to audit the exam. It's not likely to have a specialist involved in the examination. And the typical timeline for an SBSC examination is in a 12 to 18 month time frame. In LBNI, it's reserved for those taxpayers with assets that are greater than $10 million. It's likely, well, you could have a single revenue agent, but it's likely you're going to have multiple revenue agents, and you'll probably also see the involvement of a specialist to help out in the examination. The time frame for an exam for LBNI is in the 18 to 30 month timeline. It's considerably longer.
I'll start out talking about how the IRS selects returns for audit. What everybody wants to know, if I file for the research credit, is that going to trigger an audit? And the answer is it depends. There are multiple ways that a return could be selected for audit. There's a computer algorithm most of you are familiar with called the discriminant inventory function. That's very closely guarded. There's compliance initiative projects where you're trying to look at something, the way it's been treated in the industry. Tax shelters, I'm all familiar with that. Listed transactions where taxpayers have identified something on their return, the way they've treated it. Prepare projects are where you've got a specific preparer and they're consistently making a mistake in the way they're treating an issue or way they're preparing return, and they go in and pull all those returns from the preparer, ask them who your clients. Promoter projects are related to abusive transactions, tax shelters, where they try and get a list of their clients. Filters are something they try occasionally to try and improve their selection to get the returns with the highest risk. And they may or may not be incorporated in the discriminatory function. Those are very closely protected. When you work on a filter, if you have to turn everything back in to the people that are evaluating it. And if you work on a filter and select the returns using that filter, you can't actually audit the returns. So that's a common misbelief that people are selecting returns and then audit them. And the exact opposite is true. If you're engaged in any part of the selection, you can't be engaged in any part of the audit of those returns. Classifications are hands-on. I've done that a lot of times, and mainly with the state gift, where they had valuation issues, and they want to look at the engineers and appraisers, their opinion on whether or not there was something suspect about the valuation that warranted further examination, and you would flag those. And like I said before, we would do them for different parts of the country other than the area that I was responsible for, which was Ohio is where we did them. And then somebody in California would be looking at the classification for the Midwest returns. Amended returns claims is where you can actually, if you're filing a claim, that can be flagged when it's coming in, and you can have an analyst set up a project to look at those returns. And that's where your likelihood of being audited related to the research credit could slightly increase above the average return. But otherwise, the research credit is really, whether or not you have it's not going to impact whether or not you're selected for audit. So how does the audit begin? The case manager orders returns. They get some, and they're weighted on how likely there are to be a problem on those. Then they review them for potential issues. They assign them to revenue agents. The revenue agent, again, looks at them for potential issues. And they may or not, any step in that process, they may not start an audit. They may just say, we're going to survey this return, put it back in inventory, it's closed out. You never know about it. But when they're reviewing the information, they look at what's available public, the transactions that you've published, and your K1s if you're publicly traded, 10Qs, said that wrong. And then finally, if they do start the audit, they'll contact the taxpayer. On the large audits, they're already on site typically, and there'll be a negotiation. Go to the tax department and say, you know, when we finish up this cycle, when's a good time for you guys to start the next cycle? Because the Fortune 50 companies are almost always under audit. The specialist referral system is where anybody within the IRS can request an assistance from a specialist. And there are a lot of different ones. There are economists, there are art appraisals, there are actuaries. But the big ones we were going to talk about related to research credit are engineers, computer audit specialists, subject matter experts, local and national counsel. The engineers most likely to be involved. They're part of LBNI, but they support all of the IRS. They have disciplines in numerous engineering degrees. I've had mechanical, electrical, nuclear, civil, all those. A lot of them have graduate degrees. Some of them have CPAs. Some of them have JDs. I know a couple engineers have both. In LBNI, the research credit's assigned to an engineer about 90% of the time, a little bit more than that. And SB is less than 5% of the time they get an engineer on their cases, just because there are not that many engineers in the IRS, and they tend to focus on the bigger cases with the most money involved. Occasionally, a return will be, or request for referral will be rejected, and the SBSE manager will go back to the engineer manager and say, look, I really need help on this. And if you can't give us an engineer and have them work the case, how about giving us some consulting time? And they'll do that about 5% of the time. They come in and look at maybe an IDR responses, help with the interview, that type of thing. They're not responsible for the case. They're just trying to provide guidance and assistance to the revenue agent conducting the audit of the issue. Computer audit specialists are next mostly likely to be involved. They're revenue agents. They have specialized training. They assist with retrieving and analyzing electronic data from the taxpayers, basically translating the data from the taxpayers' systems to what the IRS can handle. Their involvement with the research credit is typically related to a statistical sample. Either the taxpayer did one or the IRS wanted to do one. If the taxpayer did it, they're going to make sure it's in compliance with the Rev Proc 2011-42. They create sampling plans for revenue agents and engineers if the IRS is going to do one. And there's a couple of sampling coordinators nationwide on the more complex cases that they can go to for assistance and support. The subject matter experts, they're part of the LBNI Business Credit Practice Group. They used to be called tech advisors, probably a lot of you are familiar with that. And they're the subject matter expert in SB is still called a technical advisor. There are also some analysts in the SBE that are dedicated to the research credit issue, both for reviewing the returns and the reports of the revenue agents to make sure that they're consistently treating the issue the same nationwide. And we'll talk more about that a little later. The counsel became involved several different ways. The revenue agent may request it, a specialist may request it, taxpayer or rep may request it. Both LBNI and SB have local and national counsel. The national counsel, if they're called in because of the research credit, that's all they work on typically. They're experts on the credit, every aspect of it, all the court cases, and the current IRS guidance on the issue. And the guidance comes from, initially, Congress writes a law, Section 41. It was made permanent in 2015 with the Protecting Americans from Tax Act. And one thing about that is you never knew if it was going to be permanent or not. So people never really put any effort into establishing, methodologies and practices for collecting the data. But now that it's permanent, you're starting to see people maybe make some changes into their accounting systems to collect data for this tax credit. Treasury writes the regs, and the regs may be proposed regs, temporary regs, or final regs. There's a proposed rulemaking notice that goes out. There's electronic reading room, and there are public comments available on those. And those public comments are looked at, and they may change the temporary regs or the proposed regs, and even final regs have been brought back based on proposed comments made temporary again, and then new final regs issued. And that happened quite a bit, especially with the internal use software regs that were finally finalized after about 20 years. And we'll talk more about that later. Guidance also comes from the subject matter experts and additional counsel. They'll develop audit technique guides. There are 5 audit technique guides on the research credit issue that touch on it. There's the general, there's a research claims audit technique guide that came out when it was a tiered issue, and it was mandatory to look at it and treat it that way. There's software audit guidelines, an aerospace industry, a pharmaceutical research. And then, as we said before, there's LBNI practice units, and every practice unit is responsible for a section of the code, and the business credit practice unit is responsible for the research credit. There's a directive that came out, and if you treat your research expenses for book, then you can have some safe harbor treating the same expenses for tax. There's some exceptions, and there's also some ways that if you didn't treat an expense for book for research purposes, you could still pick it up for tax, and there's ways to do that. And then the SBSE technical advisors, the analysts also we talked about earlier, they also weigh in on guidance for the field. Finally, guidance also comes from tax cases. There are 2 types of tax court cases and district court cases. In tax court, the judges only hear tax-related cases. If you've got a tax court memorandum case, that just means it's not reviewed by all the judges. And if you go to tax court, you don't pay tax prior to court. District court cases are different. You pay the tax and then you sue for a refund, and the decision sets precedent only within that district. And you can have 2 different cases in different districts with similar fact patterns and come up with different results. And when that happens, the IRS will try and have it elevated to the Supreme Court to get it where it sets precedent across the country with all districts. And that's happened occasionally on different tax issues. There are over 60 court cases addressing research credit issues, and they touch on different aspects of it. They'll stipulate, both sides will stipulate certain facts so that they can focus on some aspect of where they can have a point of contention. And it may be the partnership level, and that may be what the IRS is trying to bring to the court to get some guidance on. Gross receipts, substantiation, base period, all of these. But if you've got anything about the research credit that you're concerned about, and you do a search on it, you can find the related a court case, and there's some web pages that have it segregated by court case and the parts of the research credit that was addressed by the court.
Well, you should know that the examinations of research credit require a lot of resources at the service. And there have been a lot of initiatives that the IRS has put forth to try and improve the examination. SB, the small business and large business, have both in the past and in the present, they've had ongoing initiatives to improve the efficiency of these examinations. And they've tried all kinds of things. They've focused projects on improving the taxpayers' awareness of the credit. They've tried increasing training for their own examiners. They've built auditing tools or created new auditing tools to try and speed up the exam, and a host of other developing issue strategies they're still working on now. Some of the SBSE initiatives on the credit, originally, well, they had a joint initiative with LBNI years ago. Both divisions collaborated to try and develop strategies and issue positions. They were very similar. Since that time, SBSE decided to groom their own dedicated analysts that would focus on the research credit. And in 2016, SBSE had a directive, and they stated that all R&D exam reports would be reviewed by this team of specialists. I wouldn't say specialists, team of dedicated analysts. In 2018, SBSE formed 3 dedicated teams to work these R&D cases, and these teams have been aligned geographically. There's one on the East Coast, there's one in the Midwest, there's one on the West Coast. In LBNI, they've also tried many initiatives to try and streamline the credit. There was originally a record-keeping agreement pilot to try and improve records to be examined. R&D credits have been assigned as tiered issues. Jack mentioned that previously. There are at least 4 studies conducted by engineering personnel alone to improve the efficiencies of the examination. Currently, LBNI has a multidisciplinary R&D team in place to investigate the past results of all these exams and try and apply that information to improve future examinations. Perhaps you've heard about campaigns, especially at LBNI. There are about 45 announced campaigns in LBNI, and most recent additions included just last fall that LBNI announced a new R&D credit campaign. Engineers have been asking for that for years, so they finally have this campaign dedicated. Let's see. I apologize. Note that the division maintains a practice area, and this is composed of the subject matter experts Jack mentioned, and those folks are dedicated to research credit, and they're out there to assist the field operations. And you should also know that the R&D effort is jointly owned in LBNI between the business credits folks and also the director of field operations for engineering. Okay. The LBI differences between LBI and SBSC audits. There is published guidance which focuses on collaboration, and that's this. You'll also see the LEP, the LBNI examination process, and there's a link here. Note that LBNI has an audit plan separate from the risk analysis. LBNI has also issued a directive on centralized risking for all research credits. So this new multidisciplinary team is now taking a look at all of the research credits that are coming in, and they're going to be centralized risking to try and pick what they think is the most important cases to address. There is a directive out that published on the IDR process. It's good to be aware of this so you understand how the IDRs work, and you can play ball with the service. Exam teams on larger cases, they may have a team coordinator and multiple personnel and other agents and specialists assigned. So you could have in a large case, it's a good chance you're going to be facing a team of examiners. Larger companies have traditionally been under continuous audit. I think Jack mentioned that, like the Fortune 50, their agents are camped out there all the time. And for the large cases, these big cases, LBNI, the audit time goal is 18 to 30 months. In SBSE, the approach to the exam, it limits the examination to a single revenue agent. That case is going to be assigned to an agent who is a member of one of these new geographic teams that I mentioned. The recurring audits are not likely, like you see in LBNI. In SBSE, the risk analysis serves as the audit plan. The IDRs generally follow the examples that are in the audit technique guide, which was developed by the LBNI folks. And you also see that the SBSE exam time goals are much shorter in the 12 to 18 month time frame. Risk analysis of the IRM in the Internal Revenue Manual. Risk analysis really is defined as comparing the benefits of examining an issue to the resources that you need to examine it. And the managers are always looking at risk analysis. They really want to increase productivity, trying to improve the audit planning process, trying to reduce the cycle time, trying to increase audit coverage, and believe it or not, they're trying to reduce the taxpayer burden as well as their own burden. And it's important to know that the IRM states that risk analysis should be considered at 3 points during the exam. At the pre-audit phase, the examiner is going to be considering the risk analysis at the midpoint of the examination, and also if a significant event occurs. So if you are being examined, it's good to understand this, because perhaps if you're at the midpoint and you're not getting very far, maybe that's a good time to sit and speak with the IRS that maybe we could reduce the risk in this and maybe be done with the exam sooner. Overall, the goal of an examination is to determine the substantially correct tax liability. And the 80-20 concept weighs the impact of potential results with additional case time. So this should be applicable throughout the audit to evaluate and determine the scope of the examination. Okay. What is qualified research for the credit? And the most important part of this really is the 4-part test, and this is defining what qualified research activities are. The first of the 4-part test is the Section 174 test, and here your activities must be incurred in a trade or business. The second test is the technological nature test, and this is a process, you should be using the process of experimentation, which must rely on scientific principles, so it's scientific related. The business component is number 3, and your activities really need to apply the information to a new or improved business component. And the 4th one is the process of experimentation, and you must use a process of experimentation in your activities. And again, be aware of the 80% rule to shrink, that if 80% of your activities are qualified, then the balance may also qualify up to 100%. Shrink back, finally, is if the requirements for eligibility are not met at the first level of that business component, the 3rd-part test, you may be eligible if you shrink back to the first level of the business component or the next subset of that business component. So always, if you're getting a no on your process of experimentation for business component, always consider shrinking back to a subset to try and pick up that qualified activity. Okay, what are the expenses? Well, qualified research expenses, there's really 3 principal costs, if you will. One is wages, and you're paying employees that are performing or directly supervising research. And again, there is a substantially all rule here that if you've got a lab worker spending 85% of the time in research, then you can in fact claim 100% of their wages. This is because substantially all of their activities are research. Supplies is the next wicket, and these are supplies that are used or consumed in the research activities. And these supplies cannot be depreciable to the entity that's performing the research and development. The 3rd expenditure really is contract research. If you're contracting out for your research, only 65% of those expenses are qualified. All of these expenditures for contract research must meet the same qualified research activities as we've talked about. Plus, you have to own the rights to the research, and you have to be at risk for the success of that research. And things that are excluded, specifically excluded in the Internal Revenue Code, you should be aware of these. If you have research after your business component is already a commercial production, that's disallowed or it's excluded. Surveys and studies, marketing studies are excluded. If you're just adapting an existing business component, one that you've already had and you've already researched, it's going to be excluded. All foreign research is excluded. That's pretty simple. If you're just duplicating an existing business component that you haven't changed anything on it, that's going to be excluded. Any kind of research in the social sciences is excluded. Funded research is excluded if someone else is paying you to do it. And the last thing is interesting, that internal use software, IUS, used to be excluded, but it can now qualify if you have 3 additional tests that are satisfied, and Jack's going to talk about that in a little bit.
When the auditor does come on board and then the revenue agent's starting to look at it, what are they going to be looking at? Well, they're an accountant, so the first thing they're going to be looking at is the credit calculations, whether or not you use the traditional method or alternative simplified credit. Look at your consistency with the base period, any 280C elections you made, whether they were correct. If you did allocations for dispositions and acquisitions, does that make sense the way you did it? Whether or not you're a startup company, if you did any basic research or you worked with a university or a consortium and now you captured those costs, they're going to really look at that because they're comfortable with that. Next thing they're going to look at is estimates. And as Mark was talking about, if you've got a time tracking system and you've got project accounting data and you're not using it and you use estimates instead, expect them to really dig into that and say why they're not good enough for the research credit, but maybe you use them for budgetary purposes or for payroll purposes or whatever, but you're not using that same data for a research credit. If you've got somebody that's 2 or 3 levels above and they're making an estimate for individual employees where it's not reasonable to expect them to know what individual employees are doing, they're going to want to know, how did you arrive at that estimate? Where's your support for that? Is it, objective? Estimates are typically multiples of 5. That's just the way everybody works. If you say 60% of the time they were doing this, 70% of the time they do this, 35% of the time they were doing this, they expect that. If you come in instead and say 47.23% of the time they were doing this, and that's an estimate, they're really going to say, okay, that level of accuracy implies that you have something to support it. Where is it? So you're better off keeping your estimates in line with what you can actually support. If you've got high estimates for senior managers who are there 2 or 3 levels above, so they're not directly supervising somebody that's conducting research, they may be conducting research themselves. That happens. I've had cases where you have someone that's a vice president and they were given that title to justify their salary, but they're still working in the lab and actually conducting research. Their names will be on the patents. That's okay if that happens, just expect the question. So the next area we're going to talk about is the Nexus. And you'll hear it's in some of the audit technique guides, and that is the way that the revenue agent can actually make an adjustment, is the bottom line. The expenditures have to be related to the business components, and they have to be related to activities. All 3 of those, if you say this activity doesn't qualify, then you've got to be able to tie it to an expenditure to make an adjustment. If you say, okay, you're duplicating someone else's business component, you've got reverse engineering here, that's not qualified, you've got to tie that activity and those expenditures back together. So they're going to expect that Nexus. If it doesn't exist in your study, which a lot of the time it doesn't, expect to have to come up with it during an audit. If you've got a statistical sample, they're going to probably bring in the CS, as we talked about earlier, and they're going to see if it meets these RevProcs. There's a field directive the CS will look at. There's statistical sample audit techniques that are out there. You can look at those. If you've got an attribute sample is where you say, based on one attribute of the sample population, you project it. And a lot of times you'll see that where, yes, this project qualified, or no, this project didn't qualify. That's typically what we say, yes or no. And they don't dig into what was actually being taken place in the project. They take it at a high level and they say yes or no, and then they project all the qualifying projects percentage-wise to the rest of the population. That will drive the CS nuts, I can tell you from experience. They want to throw out the whole sample and the whole research credit based on just that, which that doesn't happen, but it's going to cause you problems. So if you've got somebody that tells you that that's attribute sample is fine, I can tell you the IRS will not agree with them. That happens, but the judgment samples are where you say, we think this group of projects is representative of the rest of the projects, or this group of employees represent the rest of the employees. And we'd like to just take this because it's easier to do a judgment sample than it is a statistical sample, come up with sampling plan, not everything else involved with a statistical sample. Judgment samples are fine. The IRS uses them all the time. I see taxpayers use them. The key point on a judgment sample is try and get agreement with the IRS on that this is an appropriate judgment sample. Get their buy-in, and it may be, a judgment sample may be as simple as you got 4 years under audit, we're going to take 1 year. If everybody agrees this 1 year is representative, the other 3 years, then that's all we're going to audit, and we'll project the results. That doesn't mean you agree with the IRS. It just means you're not going to argue about the projection. You can still say, that was a qualified activity, or, that you disallowed some expenses that were qualified. That's okay. You just don't bring in whether or not it was a valid statistical sample, since you both agreed to use a judgment sample. The revenue agent may look at job titles. They're going to try and identify second level above managers who are not directly supporting it. We talked about that earlier. They're going to look at people like, you've got the activities that are not normally, you don't think of research, salespeople, quality control, safety. They're going to say, how were they involved in the research? And they may have been, and that's fine. Just expect the question. If their performance plan, if you got somebody that's a technical sales engineer, and all their compensation is based on sales, they're on a commission basis, and you're saying 50% of their time they're engaged in research, that's not going to make sense. You know, you're not getting compensated for that 50% of the time, so you're going to have to explain that. If their calendar shows they're in trade shows and they're traveling all the time, and you say 30% of the time they're engaged in qualified research, and the research is being conducted in this lab where they're very rarely at that lab, you know, expect those type of questions. So that's maybe the type of information they'll be looking at. Is I'd like to see some of the calendars for some of these people that we've got questions about, or their performance plans and their compensation. Reasonable compensation is another area. It came out in the Suitor case, and basically it says that what you're paying somebody to do the research has to make sense, and it can make sense on a couple of different levels. It's been in something that's IRS engineers. They've got people that specialize in this. They've got databases on compensation and different industries, different levels. It's normally been a C Corp issue where they're using it to pay where they don't have to pay tax on it. You know, so if it's a dividend instead of a compensation, then it's not deductible. So that's the issue. But where it comes up in the research credit is if you got someone to say their job is vice president, but you say really they're acting as a manufacturing engineer, we made them vice president just for their salary. And here's what they're doing, this qualified research, and they're making, say, $600,000 a year, and you say, oh, that's research. But if you look at the manufacturing engineers in that segment, the salary range maybe goes from $100,000 to $250,000 for the best manufacturing engineer. They're going to say that other $350,000 that you're paying this person, that's not reasonable. You could get the best manufacturing engineer out there to do comparable work for $250,000. So we'll agree that the $250,000 is appropriate for the research they're doing, but not the additional $350,000. That may be the type of thing you run into. Then, and there may be, you say, well, he's not the typical manufacturing engineer. This guy is the leader in the industry, has all kind of unique knowledge and patents that nobody else understands. So even though he's a manufacturing engineer, he's a key personnel. There are arguments to make both ways. It's a very complex issue, and if you get involved in that, a lot of times these small business revenue agents will make that argument when they really don't have the expertise needed to make it. So you need to bring somebody in and point out how complex it is and rebut some of their arguments. Documentation is going to be another area they're going to focus. Uses cases where this initially came up. The best documentation is contemporaneous information, lab reports, budget, project status reports, emails. There are problems with the contemporaneous documentation too, because when you're talking about the project, you talk about all the things that are problems and uncertainties that are unrelated to the research. And you have to point that out, that we're not claiming those aspects of the project, or those aspects make up less than 20% of the difficulty. You know, that, so, and you may actually understate the difficulty when you're trying to get a budget approved for the project. You don't say, you know, it's very unlikely we're going to make this, you know, project work because of all the technical uncertainty, but we still want you to put $10 million investment, you know, to the board that didn't do that. So those are the type of things you can run into, but that is still the best information because it shows you were actually conducting research and you didn't go back after the fact and classify something's research. There's a pro forma substantiation write-up guide that was in the research credit claims audit technique guide. And that basically said if they don't have good documentation, just disallow it all. IRS Counsel made them pull that down in less than 2 weeks, even though there's still a spot for it. If you look at the research credit audit technique guide in the appendices, it's still there, but there's no appendix. You can't find it. And the reason why is they said if research is actually being conducted, then appeals or the courts won't say you can disallow it solely based on lack of documentation. You have to point out where the documentation, even though it didn't exist, you can come up with a reasonable estimate of what the amount of research taking place was, or you have to prove that nobody could come up with a reasonable estimate. And that's kind of a high bar. So they just said, you know, don't adopt that as a single position. There's subject matter interview summaries where you bring somebody in and say, you know, what are you doing and how, what type of research were you performing, what were the technical uncertainties. Problems with those are typically they're being done by someone with a tax background, and things may get lost in the translation when you've got a scientist or an engineer explain the technical uncertainty, trying to put in layman's terms, and they may do too good a job of putting in layman's terms where a revenue agent comes in later and say, well, that doesn't sound very technical, and there doesn't seem to be much technical uncertainty. So if you're doing that, try to keep it as technical as possible, where it's still understandable. And if it's not understandable, then you can explain it later if you happen to be audited. Contract research, we mentioned that earlier. It's one of the keys. That who's at risk for the research? Type of contracts, fixed fee, you're considered to be at risk. If it's time and materials, you're going to be compensated, for your efforts. So you're considered not at risk. And who retains substantial rights? The earlier slide we said own rights. That's a little misleading. It's really substantial rights. Patents, copyrights, those are great. Who owns the intellectual property? But a lot of times it's not stated in the contract, and the contract may be nothing more than a purchase order. In the absence of any evidence of who owns it, it's considered to be jointly owned. You can not have just incidental benefits, though. If you go in and say, well, we gained knowledge and experience on this project, so that was what we retained as our substantial rights. That's not going to fly with the court. Internal use software, Mark talked about that. It's been around for a while. It was big in the banking and financial institutions. Final regs didn't come out to 2016. The 3 additional tests that it have to pass above the 4-part test has to be innovative, not commercially available. You couldn't go out and buy the software. And there has to be significant economic risk that you're going to recoup the amount of investment related to the project, not significant economic risk to the company or to the department. It's just related to the software project. So I have seen revenue agents that didn't understand that aspect of it and trying to make the argument that this, such a small project compared to the company, it's not significant economic risk. That's not what that means. It's not internal use software if it's sold, leased, or licensed, or if it interacts with third parties. That was part of the changes that came out in the final regs. And almost all software now has a customer interface with it where it's interacting with third party. So it's very smaller population than it used to be. It's classified as internal use software. MITRE referrals. MITRE is a primarily Department of Defense contractor, but for the large internal use software claims, more than $500,000 a year, there was a mandatory MITRE referral, and they have a group of guys that go out and look at whether or not the software is innovative. That's really all they look at. And they have PhDs in software development. They're from academia and from industry. These guys are that have a huge amount of experience, but they're looking at the whole software universe. If you're in a small industry and you've developed software and get all kinds of awards in that industry, that you may have similar software in another industry, and the MITRE people are likely to say it's not qualified. But this is not as likely to happen as it would have in the prior years. How you characterize your research is something that is really important because the way you describe it, there's these non-qualified areas that Mark talked about. And if you get into those, then I trained engineers and revenue agents that's not qualified. If you're conducting market research and doing marketing studies, but if you bring marketing personnel in and they're working with you to establishing the design parameters, that is likely to be qualified. Brainstorming versus identifying alternative design options. Critical design reviews versus status meeting project meeting. This is just some examples. Project troubleshooting is a very good one. A lot of times you'll have a process in a plant that'll go bad, something's going wrong, you're going to get all kind of rejects. The engineers, scientists go out there and say, oh, we figured out what's going on. So they were troubleshooting the problem. But now they said, this is going to happen every 3 or 4 years. We don't want that. Let's improve the process. Well, now you've gone from troubleshooting to actually doing qualified activity where you're doing research to figure out how can we improve this process and what are the technical alternatives that are out there, and maybe do some experimentation. But you still call it troubleshooting because that's what it initially was. And then that's going to be disallowed because troubleshooting in the IRS is you're restoring it to prior operations. You haven't improved the process. So you got to make that distinction.
Audit conclusion, there's really two outcomes. You're either going to get a no change and you're going to be happy and go on your merry way, or you're going to be notified you're going to get an adjustment. And if you're going to get an adjustment, they're going to give you a notice of proposed adjustments, a NOPA. It's also called a Form 5701, and also include a report that explains the adjustments. That's the 886A. So hopefully you can avoid those, but if you get one, we'll go to the next slide. You're going to try and seek a resolution. So there is a difference between resolution and a settlement. Resolutions can be affected at the field level. Settlement is going to be one of those things that's dollars that's going to be settled at the appeals level. The bottom line is the goal is to resolve the issue at the lowest level, and you want to, if you have a chance, you can meet with the case manager if necessary to seek a resolution. There is a thing called early referral to appeals, and this is requested by the exam team. And let's see, if you, prior to the issuance of a 30-day letter, the taxpayer requests a transfer of a developed but unagreed issue to appeals under the early referral program, and this should be discussed with the exam team and group manager. Fast track is a relatively newer process. Technically, the case stays in exam, and they assign an appeals officer to act as a mediator between the taxpayer and the exam team. And what's important is that both the taxpayer and the exam team must agree to the settlement, or to the mediated settlement. And without agreement, it leaves fast track and goes back over to exam and probably go on to appeals. Be aware of the delegation order, the DO-424, that there's a link. Here, a case manager can apply a previous appeal settlement if the similar, for that same taxpayer, if the similar facts and circumstances are the same. Within appeals, a quick overview, ex parte, be aware of it. Exam and appeals can speak to each other only with the approval and the participation of the taxpayer. So there's little chance, no chance, that the exam and appeals are working together. They cannot speak to each other without the taxpayer being there. Be aware that if the case hasn't been fully developed, it could be sent back to exam. So, if the exam team hasn't fully developed the case, or if the taxpayer submits additional information, that case is not fully developed, and appeals could send that back to exam to complete the examination, or they could choose to proceed with their own settlement. I mentioned already, new information should be returned, should force that case back to the exam to review that new information. And be aware that if you have less than 12 months on a statute extension protects your rights as a taxpayer, so you want to go along with that. In the appeals process, be aware that the appeals mission really is to resolve the tax controversies without litigation. They're not attorneys, but they are trained experts at trying to mediate or to seek a good settlement. They want to resolve the issues without going to court. They're looking for a fair and impartial solution to the government and the taxpayer. Be aware that mutual concession settlements, or also known as the hazards of litigation, occur when substantial uncertainty as to how the courts would interpret and apply the law. And also be aware that a nuisance value settlement is any concession made solely to eliminate the inconvenience or cost of further negotiations or litigation, and that is not permitted. The burden of proof is typically on the taxpayer. In rare circumstances, it can become the responsibility of the service. You should know that the appeals personnel must address the degree of taxpayer cooperation in their appeals case memos. So the appeals folks are going to be grading the taxpayer on their performances during the appeals process. The examiners have a big responsibility to fully describe all the documents used, the steps taken, and the analysis supporting all the audit conclusions. Next slide. Other programs to be aware of: private letter rulings, the pre-filing agreements, a PFA. That's a big single issue, and it's agreed to between the taxpayer before filing. A TAM, a technical advice memorandum, that's issued by Chief Counsel in response to a technical question raised by or during the examination. IIRs, industry issue resolutions. When a burdensome issue is common to an industry, it's addressed by a team of taxpayers and exam folks. And a good example of this is the ASC 730 that Jack mentioned earlier. CAP is reserved for taxpayers in the large business. Those are big taxpayers, and they essentially are going to have multiple issues agreed upon before the return is even filed. Lastly, beware of the Taxpayer Bill of Rights. It should be presented at the beginning of any exam. Examiners should perform their duties in a fair and equitable manner and are accountable to their management on a management review on a pass-fail basis. If you have a serious problem, you got the Taxpayer Advocate. It's separate from the IRS examination divisions. You can go to them independent of LBNI or SBSE. And take to observe, the Treasury Inspector General for Tax Administration is really for some serious egregious issues.
John, Jack's, and Mark's contact information can be found on this slide. If you have any questions about the material that was covered or would like to discuss an opportunity, current claim, or audit, please give us a call.